Hi, it's Mitch at Reverse Mortgage Pros, and in today's video, I'm going to walk you through how a reverse mortgage compares to a home equity line of credit. Let's get started. Okay, if you're new to my channel here on YouTube, please click the subscribe button and the like button so you'll get more content and more information to help you decide if a reverse mortgage is the right option for you and your family. Now, quick overview of this video. Now, quite often the decision that people advise about reverse mortgages comes down to choosing between a reverse mortgage and home equity line of credit. If that's the case, this video will help. I'll go through the pros and cons of both and compare them and show you what the options are and how they compare. And then also, I'm going to give you a third option that you might not have thought of where you can kind of combine the two into one. I'll talk a little bit more about that at the end of the video. I like to begin every video with a quick overview of what exactly a reverse mortgage is in 20 seconds. It's a mortgage available to homeowners over 55 that doesn't require you to repay any money. There are no monthly payments. You can get up to 55% of your home value, usually between 15 and 55%, and I'll talk a bit more about that later in this video. You can get as much money as you qualify for, but any existing mortgage on your home must be paid off first, and it's designed to help you tap into your home equity for retirement and continue to live in your home forever. That's it in a nutshell. If you're interested in more, I'll put the link to my free guide in the notes section below. Otherwise, I'm going to get started on a reverse mortgage versus home equity line of credit, or HELOC, as I'll refer to it from now on. The first round will be looking at how much you can get with each option. So reverse mortgage, as I just mentioned, you can get up to 55%, and the amount will depend on your age, location, and property type. It's generally in the 15 to 55% range. A home equity line of credit has a maximum amount of 65% of your home's value, and that amount is going to depend on your income and credit score. So the amount that you can get up to 65% is going to be judged on how your ability and how able you are to make the monthly payments and pay the income every month. And you'll go through the normal mortgage application and qualification process looking at your income and credit score, whereas those are almost completely irrelevant for a reverse mortgage. That's one of the big differences between the two right off the bat. Now, when it comes to interest rates, reverse mortgage tend to be a little bit higher than a conventional mortgage, but not as high as second mortgages or private mortgages. I put them in the middle range when it comes to mortgage products, and that would be on the lower range compared to all the available loans out there. A home equity line of credit will tend to be a bit lower than a reverse mortgage, but also not as low as a conventional traditional mortgage, the best mortgage rates that you see out there. So both of them, slightly higher rate. Home equity line of credit will be lower than a reverse mortgage though, but both good rates when it comes to mortgage or loan products. With regards to monthly payments, now reverse mortgage, there are no monthly payments, so it's completely voluntary. If you want to make them or you don't want to make them, you can pay the interest only, you can pay nothing. It's totally up to you. A home equity line of credit is mandatory. You must pay the minimum interest due each month, or you could risk losing your home and having your home taken away from you for not making payments. That brings me to the next slide. So I was a step ahead of myself here. So with reverse mortgage, you can't lose your home. The lender can't take your home. There's nothing to default on. There are no payments. There's no reason for them to come after your home. A home equity line of credit, the lender can repossess and take your home if you fail to keep up with payments. Same as any other traditional mortgage. This is one of the big differences between a reverse mortgage and the other products on the market. When it comes to repaying the outstanding balance of a reverse mortgage, you can, but you'll be subject to paying early payment penalties, which reduce over time. And what I mean by that is that if you take out a 5-year reverse mortgage and you repay it after year 1, you're going to pay a very big penalty. But if you repay it after year 4, you're going to pay almost no penalty. So the penalties reduce over time. The longer you hold the reverse mortgage, the closer to zero they get. And in fact, most of the lenders, once you get past 5 years, almost completely off-write the penalties. There's almost none. A home equity line of credit is actually an open loan, so it can be repaid at any time without penalty, so you don't need to think about that at all when it comes to repayments. A reverse mortgage is a non-recourse loan, so you cannot owe more than your home is worth. But with a home equity line of credit, technically the balance is not capped or reduced ever. So if there was a massive housing crash, you could owe more with a home equity line of credit than your home is worth. It's different to reverse mortgage in this sense. It would obviously take a pretty big housing crash for this to come into play for either of them, given that you're only taking out a loan of up to 55% or up to 65% of your home. But it's all worth pointing out when you compare the two products that this is a difference. Now, there is a third option where you can kind of combine the concepts of both a home equity line of credit and a reverse mortgage into one. This is something I created. It's not a real product. I call it like the RM HELOC, so reverse mortgage HELOC. And what I say is that you can kind of get the benefits of home equity line of credit, but none of the downsides. So how is that? Well, how it works, you can actually make voluntary repayments to reverse mortgage and repay the interest every month. So once you voluntarily repay the interest every month, you're doing exactly the same thing you would do with a home equity line of credit. The only difference is that this is manual and it's voluntary. So you're basically paying off the interest and the balance owing won't increase over time because you're covering it exactly how it works with a home equity line of credit. Again, I call it the RM HELOC, reverse mortgage home equity line of credit. Again, it doesn't exist. This is just kind of a concept that we came up with here at Reverse Mortgage Pros, where you can make voluntary payments and you get the benefits of home equity line of credit without any of the downsides, the stuff like risking your home. And it's a good option in that the payments are voluntary. So if you need the money in any given month, you don't have to make the payment. It's always voluntary. And so it gives you a bit more flexibility and a bit more freedom than a home equity line of credit where you must make that payment every single month or you're going to run into trouble and you're going to put your house at risk. So why would you take out a home equity line of credit? Well, if you qualify for it, if you have the income, the credit score, and you're comfortable making the monthly payments, it's a solid mortgage option. There's nothing against home equity line of credits. I have one myself. But if you're not comfortable, you want to get rid of the monthly payments, you don't qualify for a home equity line of credit, or you want to take out a lump sum balance to help with your retirement, then a reverse mortgage is a very good option for you. And so hopefully with the information in this video and some of the other videos on my channel and my guides and my website, I'll be able to help you decide which is the right option for you if this is something that you're considering, or hopefully you might even have already made that decision and this video has helped you come to the right decision for you. It's going to be different for every single person. For some people, one option is great. For some people, the other option is great. You just got to do what's right for you and your family. So in summary, this video I went through differences between reverse mortgage and home equity line of credit. I also suggested a third option that isn't a real option, but just kind of a concept that I call the reverse mortgage line of credit, where you take out a reverse mortgage and you make every month you voluntarily pay the interest. So you're basically doing exactly the same as a home equity line of credit, except that now the payment's voluntary. And again, which product is right for you will depend on your own personal circumstances. However, if you're interested, I'd be happy to give you a free assessment and advise you as to whether or not a reverse mortgage or home equity line of credit is the right solution for you, or if even something better or different from those things is a good option for you. All you need to do is click the link in the video notes or go to reversemortgagepros.ca/apply now. Again, I'll put the link below the video, but it's reversemortgagepros.ca/apply now. It's a 90-second online form. I call it a reverse mortgage assessment because I'm assessing to see if this is a good option for you or if there are better options like a home equity line of credit out there. If you've got any questions or comments or something that I've said that you're interested in learning more about, then leave them in the comment section. I'll try to answer every single one of them. Might not get to immediately, but I'll try and get to it as soon as I can. Otherwise, I hope you enjoyed this video and thanks very much.